Palantir CEO Alex Karp made headlines this week by questioning AI industry growth in a surprising interview. He described the sector as overhyped and discussed the complexities of the current token economy. The AI trade is undergoing a major shift. In 48 hours, two industry leaders, Karp and Zuckerberg, suggested that the aggressive spending and optimism surrounding AI might be facing a reality check. A side-by-side comparison reveals the stark contrast. While Karp publicly criticized the token economics of top AI labs on live TV, a leaked recording showed Zuckerberg expressing that agentic progress has been slower than expected. The sequence of events was striking. Following a manifesto on AI sovereignty, Karp delivered his critique, followed quickly by a leak from Meta. This was not noise, but a colliding narrative. These admissions suggest that private doubt is going public. When industry insiders, rather than critics, question the current AI investment cycle, it fundamentally impacts the market's perception and potential for repricing. We are now moving into the first shot of this analysis, the Karp rant. We will explore why his critique is significant given his role in the AI industry. Why does Karp's rant hit differently? As the head of a major AI firm, he has unique insight into deal flow. When he calls the sector oversold, it carries weight, because he is not an outsider. During his appearance on CNBC's Squawk Box, Karp used the platform for what felt like a controlled demolition, balancing news of a new NVIDIA partnership with a sharp critique of token-based models. His core message was blunt. The underlying models have been completely irresponsibly oversold. Coming from an industry leader, this headline sparked widespread discussion. Karp's diagnosis is that the current method of selling AI to enterprises is fundamentally flawed. It's not about being early. He suggests the entire framework is broken. Karp channeled the frustration of CEOs, noting that they feel they are getting no value from token usage while their intellectual property is at risk, leading to quiet resignation. The era of token maxing appears to be ending. This strategy, which prioritized volume over return on investment, is being abandoned as enterprises demand measurable results. Karp also highlighted how enterprises feel they are funding their own displacement, with their operational data being used to train the very models they pay to access. The enterprise revolt is largely quiet, but significant. Executives are privately checking out, which is a major risk for the revenue models of frontier AI labs. Evidence of this pullback was visible before the interview, with major tech firms like Uber and Microsoft already restricting access to expensive AI tools. Palantir's 9-point manifesto, published just before Karp's interview, framed data retention as a company's greatest asset, suggesting that offloading data is a risky move. This was a calculated launch event. While Karp's comments appear as a critique, they also serve as a product pitch. He advocates for deploying models in air-gapped environments where customers retain control of their own data stack. The financial results back up the narrative. Palantir reported 85% year-over-year revenue growth in Q1, with U.S. commercial growth at 133%, validating their shift towards sovereignty-focused products. Beyond the token critique, Karp issued a warning about China. He noted that competitors like DeepSeek and Baidu are creating comparable models with significantly lower capital expenditure. We are now moving to the second shot of our analysis, the Zuck leak. A leaked internal recording from Meta brings new challenges to light regarding AI infrastructure spending. In an internal town hall, Mark Zuckerberg addressed staff after a major company reorganization. Reuters obtained a recording of the meeting, revealing a more cautious outlook on AI agent progress. Zuckerberg admitted that agentic development has not accelerated over the last 4 months, as originally expected. This is a crucial observation given Meta's aggressive investment strategy. Zuckerberg noted that certain bets on their new structure have not yet come to fruition. This follows a difficult period where 10% of the workforce was laid off. The scale of Meta's investment is immense, with $145 billion committed to infrastructure this year. When agentic progress lags, the efficiency of this spend comes under heavy scrutiny. The reorganization involved reassigning 7,000 employees. Internally, the process was described as messy, highlighting the friction inherent in such a rapid shift toward AI. Looking at the timeline, Meta moved from an optimistic stance early in the year to a more realistic readout in July. This delta is what investors are now closely monitoring. Zuckerberg acknowledged the reorg could have been cleaner, and that there were miscalculations regarding timing. Such transparency is rare, but carries significant weight with the market. The goalpost has now shifted to the next 3 to 6 months. Zuckerberg promised more significant benefits from AI infrastructure during this period, creating a new timeline for results. Side issues, such as Meta's internal software for tracking employee activity, have also emerged. While not directly related to CapEx, it underscores the intensity of their internal data collection drive. Following the leak, Meta stock experienced a decline of nearly 5% on the same day. The market appears to be repricing its conviction in the current AI spending story. Moving on to our third section, the bubble math. While individual headlines grab attention, we must look at the base rate of spending, which was already at historic levels before this week's developments. We are looking at the largest capital expenditure cycle in market history. By 2026, big tech is projected to outlay over $700 billion on AI, with Meta alone accounting for $145 billion of that total. The demand-side data provides a sobering perspective. A February 2026 NBER survey of thousands of executives found that 90% report no measurable impact of AI on their workplace or overall productivity. Consider the OpenAI math problem. They have data center commitments exceeding $1 trillion over 8 years, yet their annual recurring revenue is roughly 70 times smaller than those obligations, with losses projected through 2028. We've already seen a preview of potential volatility. In late June, a global sell-off in chipmakers, including Samsung and SK Hynix, caused a temporary halt in trading and rippled through the Nasdaq, serving as a warning. This creates a paradox. The Nasdaq just finished its best quarter since 2020, yet we see signs of internal deterioration. High-growth infrastructure gains are occurring alongside increased hedging by market participants. Analysts are increasingly comparing 2026 to the 1999 dot-com bubble. Similarities include circular funding loops where tech companies invest in each other's demand, and a narrative that infrastructure spending is inherently infinite. We identify 4 primary stress points: token pricing power, enterprise renewal rates, heavy reliance on private credit to fund data centers, and the looming deadline for tangible results from major spenders like Meta. Looking at unconventional indicators, we note the actions of Peter Thiel, a co-founder of Palantir. He has liquidated his significant NVIDIA position and recently relocated his family to Argentina, citing various global risks. Furthermore, insider trading data shows massive sales by executives at NVIDIA, Palantir, and Broadcom. Over $16 billion in sales were reported by tech insiders in 2025, with almost no meaningful equivalent purchasing activity. In this market, truth often acts as a liquidity event. When internal admissions or leaks contradict the established growth narrative, bids frequently vanish, leading to rapid, correlated market corrections. Now we reach the final section of our analysis: how we, at Hollow Point Trading, are positioning ourselves amidst these shifting signals and structural risks. Our framework is built on 3 pillars: macro, fundamental, and technical. We are currently observing a flip in market reflexivity, where spending is no longer treated as a guaranteed bull case. In our first scenario, we consider a, quote, confession cascade. Should Q3 earnings show that AI revenue cannot justify existing capital expenditure, we anticipate significant multiple compression across the sector. Conversely, our second scenario acknowledges that momentum is a powerful position. We remain wary of fading an established trend purely on sentiment, unless technical indicators confirm a change in underlying market health.